Okay, let's unpack this. Wall Street is currently writing 10-year debt structures backed by microchips that will basically be obsolete e-waste in 18 months. Welcome to the deep dive.
Thanks for having me. And yeah, it's the ultimate duration mismatch. We're seeing this executed on a scale that honestly makes previous credit cycles look like a rounding error.
Right. It's wild because, today is August 15, 2026, and anyone watching the tape knows the AI narrative has completely mutated.
Completely.
The gold rush is no longer just confined to, training large language models or pushing silicon to its absolute physical limits. The real game, the high-stakes systemic game right now, is about collateralizing the underlying infrastructure.
Exactly. We are moving from building artificial intelligence to just straight up securitizing it.
Which is terrifying when you really look at it.
It is, because they are layering immense structural financial leverage onto assets that possess an inherently terminal and violently short life cycle. The implications for macroeconomic stability here are just profound.
So our mission today for you listening is to tear down the engine of this new machine. We're going to examine the sudden, really explosive rise of collateralized compute obligations, or CCOs.
Right, the CCO.
And the credit default swaps the CDS being written against them. But we are looking past the standard Wall Street prospectus today.
We have to. The standard prospectus is practically fiction at this point.
Yeah, exactly. We are filtering this entire phenomenon through the cutting-edge risk framework of Dr. Professor Yogesh Malhotra. We need to figure out if these structured finance vehicles are resting on flawed, what he calls backward AI models.
Which they almost certainly are.
Right, models that are totally blind to Nietzschean uncertainty.
Yeah, and Dr. Malhotra's thesis presents a really chilling possibility here. He argues that the financial sector's reliance on historically trained algorithms to price the risk of an unprecedented forward-looking technology, it's not just mathematically unsound.
No, it's a disaster waiting to happen.
Yeah. Right. It is a literal blueprint for catastrophic systemic failure. So transitioning to what he categorizes as forward AI might literally be the only viable mechanism we have left to map this risk.
Well, let's start with the architecture of the CCO itself. Because mispricing risk, it begins with misunderstanding the collateral, right?
It always does.
We all know how a standard asset-backed security operates. You take a pool of auto loans, you securitize the cash flows, you tranche them out based on subordination levels, and you sell them.
Standard Wall Street plumbing.
Right. But in a CCO, the underlying collateral is AI compute infrastructure. So we are talking physical NVIDIA GPUs, your H100s, your newer B100s, bundled alongside data center leases and long-term cloud compute contracts.
And the sheer scale of this issuance is what demands our attention. Looking at the data from 2025 alone, we track $65 billion of GPU-backed debt just flooding the market.
$65 billion. That is, that's just staggering.
It's massive. We saw CoreWeave secure an $8.5 billion investment-grade financing facility. And that was followed almost immediately by a separate $3.1 billion publicly syndicated facility.
Wow.
Yeah. Institutional yield hunger is driving this whole thing. Fixed income investors are watching hyperscalers like Microsoft, Meta, Google. They're watching them deploy $1.25 trillion in AI CapEx.
Right, and they want a piece of that ass.
Exactly. They are desperate to capture that yield, but, without taking on direct tech equity volatility.
So we have this massive capital rotation. In previous cycles, if you had a tech startup building out infrastructure, they would issue equity, dilute the founders, and use the venture capital to buy server racks.
That was the old model, yeah.
But now we're utilizing special purpose vehicles. The SPV absorbs institutional debt, purchases the GPUs outright, and signs a long-term compute lease with a major tech player.
Right, and the rental payments from the tech giants service the debt yield.
But wait, so looking at the structural covenants here, I have to challenge the baseline premise. Are these vehicles actually backed by the physical microchips sitting in a rack? Or are they effectively backed by the cash flow from a tech company renting the microchips?
That is the trillion-dollar question.
Because those sound like two very, very different risks. Pricing the secondary market value of a used GPU versus pricing a corporate tenant's risk of default are two completely different quantitative exercises.
You've hit the nail on the head. That repossession mechanic is exactly why mislabeling these structures is the real danger here. You are isolating the fundamental divide between asset-backed and contract-backed financing.
Okay. Break that down for us.
Sure. So if a CCO is truly asset-backed, the principal recovery modeling relies entirely on the hardware's residual value. If the SPV's tenant defaults, The legal mechanism triggers repossession.
So someone literally goes in and unplugs the machines.
Basically, yeah. The physical servers are powered down, the memory is wiped, and the GPUs are liquidated on the secondary market. In that scenario, your recovery rate is heavily dependent on the depreciation curve of the specific chip architecture.
Which means if I'm holding the mezzanine or equity tranche of that CCO, I am directly exposed to the hardware upgrade cycle.
Entirely exposed, yes.
Thanks.
Conversely, if the structure is contract-backed, your recovery relies overwhelmingly on the customer's operational solvency. It relies on their legal commitment to keep paying the lease, completely regardless of the hardware's ongoing utility.
So even if the chip is a dinosaur, they still have to pay.
Right. And the toxicity entering the market right now, which is highlighted extensively in our sources, involves SPVs marketed to institutional investors under the guise of hard asset collateralization.
Oh, I see.
Yeah, but in economic reality, their viability is completely tethered to the cash burn rate of a handful of AI startups or, the continued CapEx subsidy of a single hyperscaler.
So if 2008 was built on houses, which, might lose value, but you can still live in them, CCOs are built on things that essentially expire. It's like building a 10-year mortgage on a smartphone that will be totally useless in 18 months.
That is a perfect analogy. The echoes of 2008's collateralized debt obligations are just deafening right now.
It's eerie. I mean, we are seeing SPVs used to shift immense risk off originators' balance sheets, relying on these opaque rating models to appease a ravenous demand for senior debt.
The mechanical parallels to the subprime mortgage CDOs are stark. I mean, both rely on the SPD structure for bankruptcy remoteness. Both utilize complex subordination to synthesize AAA ratings from sub-investment grade components.
Right. They take a bunch of junk and magically stamp it as gold.
Exactly. But the point of divergence, and this is what keeps risk managers awake at night, is the foundational asset. In 2008, residential real estate retained persistent utility.
Right. You can live in it.
Yeah. Even amid a global liquidity crisis and a total collapse in collateral valuation, a physical house provides shelter. Its baseline intrinsic value degrades linearly and very slowly over decades.
But a graphics processing unit doesn't do that.
No, it operates on a fundamentally different physical reality. It is an accelerating obsolescence asset.
Let's drill into that duration mismatch. Because you are structuring a 5 to 7 year debt tenor on a piece of technology that hits its operational half-life in, 18 months?
If that.
That isn't just depreciation, that is terminal velocity.
And that terminal velocity requires an entirely new quantitative approach. Standard linear depreciation models are just useless here.
So how are they calculating it? Or how should they be?
Well, the technological obsolescence equation provided in our underlying research outlines this. It's a function where the residual value at any given time, SRE, is based on price, performance, energy, utilization, replacement costs, and demand.
Okay, let's break those variables out of the theoretical and apply them to a live data center environment. Performance and price are obvious. When NVIDIA drops a new architecture, like Blackwell, the older Hopper architecture takes an immediate pricing hit.
Right, a massive hit.
But energy, that's the silent killer in this equation, isn't it? As baseload power costs spike, older chips become economically radioactive.
Radioactive is the right word. Energy efficiency dictates ongoing viability. If power costs rise by even, say, 15%, the operational expenditure required to cool and run a previous generation GPU outstrips the revenue generated by its compute output.
So it actually costs more to turn it on than you make renting it out.
Exactly. It becomes a stranded asset. The moment a breakthrough architecture hits the market, say a quantum leap in tensor processing units or neural processing units, the recovery rate modeled in the CCO's asset-backed covenants doesn't just decline, it evaporates.
Wow.
A recovery assumption might drop from 60% to 15% literally overnight.
And if that residual value drops to 15%, the waterfall structure of the CCO is completely obliterated.
Wiped clean.
The equity tranche is wiped out. The mezzanine tranche takes a massive haircut. The senior debt suddenly finds its loan-to-value ratio completely inverted.
It's a bloodbath.
But wait, standard portfolio theory dictates that you hedge against individual localized failures through diversification. In the 2006 CDO, you bundled mortgages from Nevada, Florida, and Ohio, assuming regional housing markets wouldn't all crash synchronously.
Right, the geographic illusion.
Yeah. So how are CCO managers synthesizing diversification when the entire global supply chain runs through basically one foundry in Taiwan and one chip designer in Santa Clara?
Well, they are attempting to construct portfolios using a metric defined in the literature as ineffective or effective diversification. But you nailed it. The geographic illusion of 2008 has simply been replaced by a corporate illusion today.
A corporate illusion. I like that phrase. How does that work in practice?
So a CCO manager might bundle leases from customer A in generative text, customer B in autonomous driving, and cloud provider C in enterprise software.
So they look like three totally different industries.
Legally and operationally, they're distinct entities. On paper, it looks diversified.
Yet fundamentally, they are running the exact same workloads on the exact same proprietary CUDA software stack, heavily dependent on the exact same foundational LLM APIs.
And that is the oligopoly concentration risk. The economic diversification is practically zero.
Because if the foundation cracks, the whole house comes down.
Exactly. If a regulatory shock hits foundational model training, or if a single critical hardware flaw is exposed in a dominant chip architecture, all three supposedly diversified revenue streams default simultaneously.
So the correlation coefficient approach is one.
Yes. It completely masks the systemic fragility within the legal structure of the SPV.
Okay, if this corporate diversification is just a legal mirage, no sane institutional investor is holding that raw, concentrated risk on their balance sheet without a massive hedge.
No, of course not.
They have to be syntheticizing safety through swaps. And that brings us to the derivatives layer. We are seeing credit default swaps entering the compute market.
And the introduction of CDS into the CCO ecosystem amplifies that localized asset risk into full-blown systemic counterparty risk. We are observing the rapid development of a deeply layered derivative architecture right now.
And the primary concern pulling from the historical framework of the global financial crisis is the materialization of AIG risk, right?
Yes, AIG risk is the nightmare scenario here.
Because AIG famously wrote $500 billion in protection against CDOs without holding the requisite capital reserves to fund the payouts. They were operating on the flawed statistical assumption that a nationwide correlated default was just impossible.
And we all know how that ended.
Right, with a massive bailout. So are we seeing naked CDS positions where institutions are buying protection on compute debt without actually holding the underlying asset beginning to drive market behavior?
Oh, absolutely. The speculative shorting of the AI boom is well underway. The research identifies 5 distinct layers of this emerging derivative architecture.
Okay, walk us through the layers.
Layer 1 operates at the macro level. Corporate CDS written directly against the hyperscalers. This is an institutional bet that a company's massive AI capex will impair its overall corporate credit rating.
So basically betting against Microsoft to Google as a whole.
Right. Then Layer 2 drills down to asset-backed credit protection, which isolates the specific SPV holding the data center debt.
So Layer 2 protects you if the specific physical data center goes bankrupt, even if the broader tech sector is totally fine.
Correct. You're hedging the specific facility.
Hmm.
Then Layer 3 becomes highly surgical. Tranche protection.
How granular does that get?
Very. Investors are writing swaps against specific subordination levels. So hedging against the mezzanine tranche of a B100-backed CCO while leaving the senior tranche completely exposed.
Got it.
Then Layer 4 introduces portfolio protection, utilizing bespoke over-the-counter structures that reference complex baskets of compute providers.
And Layer 5 is where the system detaches from reality, isn't it?
Yeah.
Synthetic CCOs.
Entirely detached. The synthetic CCO contains zero physical collateral. No GPUs, no data centers, no electricity contracts.
Just air.
Basically. It is an artificial yield vehicle constructed purely from a matrix of CDS contracts referencing the performance of other CCOs. It allows infinite leverage to be stacked on finite physical assets.
Here's where it gets really interesting. If I'm an investor, how do I even know what I'm hedging against? Because if I'm holding a physical CCO and I try to hedge it by stepping into this derivative spiderweb, the mechanics of triggering that insurance seem fraught with technicalities.
They are incredibly fraught.
Let's say I own Layer 2 asset-backed protection on an SPV leasing GPUs to Microsoft. I assume I'm protected if the AI bubble pops, right?
So you would think so.
But what if GPU rental yields compress due to massive hardware oversupply? The SPV can't generate enough lease revenue to cover the debt yield. The SPV defaults. My CCO tranche goes to zero.
But Microsoft, as an incredibly diversified global corporation, simply transitions its compute loads, writes down that specific lease, and easily maintains its corporate solvency.
Wait, really? So my physical asset burned to the ground, but my swap doesn't trigger because the specific corporate entity referenced in the derivative didn't default.
Exactly. The basis of the risk was mismatched. You have just defined basis risk in a multivariable technological ecosystem.
That is insane.
It is. An investor is exposed to a volatile matrix of threats: localized customer default, rapid hardware depreciation, power price inflation, and sudden technological obsolescence. Attempting to hedge that fluid, multidimensional risk matrix with a static, single-name credit default swap leaves massive, unhedged vulnerabilities buried on institutional balance sheets.
The fact that we have quants trying to model this basis risk using standard financial modeling tools brings us to the central thesis of Dr. Professor Yogesh Malhotra's work.
Right, this is where his framework is essential.
The models themselves, the fundamental mathematics Wall Street is using to predict the stability of this multi-trillion-dollar apparatus, they are completely broken. They're utilizing the wrong paradigm of risk.
Dr. Malhotra's critique strikes at the epistemic foundation of modern financial engineering. The failure to accurately appraise CCOs and their derivative layers stems from a categorical confusion between measurable risk and Nishan uncertainty.
Let's explore that distinction because I think it's vital for you listening to grasp this. Measurable risk is playing roulette. You don't know the outcome of a specific spin, but you know the exact odds. You know the mathematical boundaries of the 38 slots on the wheel.
Right. The probability matrix is absolute. Standard value at risk, or VAR models, are built on that stochastic probability. They consume vast amounts of historical data, map it onto a Gaussian distribution, and spit out this statistical probability of a default event over a specified time horizon.
They assume a continuous, stable environment where the future essentially rhymes with the past.
Yes. Measurable risk allows for precise actuarial calculation because you understand the boundaries of the system.
But Nishan uncertainty, which Dr. Malhotra elevates to describe dynamic adversarial environments, sometimes calling it quantum uncertainty, that is a totally different beast.
Completely different. It operates where the boundaries themselves are shifting unpredictably.
It's like playing roulette, but while the wheel is spinning, someone changes the numbers, sets the table on fire, and suddenly you're playing chess. You can't use past data to model that. The historical odds are mathematically irrelevant.
What's fascinating here is how Dr. Malhotra points out that current risk management models are structurally designed to fail. And they fail because they attempt to process dynamic quantum-level uncertainty through the restrictive lens of standard stochastic risk.
They treat uncertainty as if it were just standard risk.
Exactly. Wall Street is capitalizing the exact same AI growth expectation at every single node of the system based on historical correlation.
The correlation is totally circular. The perceived infinity of AI demand justifies the long-term customer contracts,
which justifies the hyperinflated infrastructure valuation,
which allows the SPV to issue the debt, which is packaged into the CCO, which is then insured by the CDS.
Yes. The entire tower is built on the historical correlation that tech stocks ascend and compute demand scales linearly.
And when a radical, discontinuous change occurs, perhaps a sovereign conflict disrupting the semiconductor foundries in Taiwan, or I don't know, this sudden deployment of a functional quantum architecture that renders classical silicon algorithms totally obsolete, the VAR models just fail spectacularly.
They have to. They assume normal distributions of events. They possess no historical data to model an unprecedented paradigm shift, leaving the financial system entirely blind to tail risk events that are, in this specific sector, highly probable.
So if the standard statistical architecture is fundamentally blind to this environment, the solution isn't to just build a slightly better VAR model.
No, tweaking the margins won't save you.
It requires a complete teardown of the analytical engine. And this is where Dr. Malhotra's portfolio introduces the pivot from backward AI to forward AI.
It is a critical taxonomy. Because the artificial intelligence commanding global attention today, generative pre-trained transformers, large language models, systems reliant on stochastic gradient descent and backpropagation, Dr. Malhotra categorizes all of these strictly as backward AI.
Because their entire cognitive framework is anchored in historical pattern matching, right?
Exactly. They are sophisticated statistical parrots. They ingest petabytes of historical data, identify correlations, and predict the next logical sequence based purely on what has already happened.
Their design makes them inherently backward-looking. I mean, they excel at optimizing known processes within stable environments.
But deploying a correlation-based backward AI system to predict the structural integrity of a CCO market that is being violently disrupted by novel technological breakthroughs is basically an exercise in futility. They cannot anticipate what they have not seen.
So to survive niche uncertainty, Dr. Malhotra posits the necessity of QA-SAN's quantum-augmented self-adaptive networks.
Yes, QA SANs.
What fundamentally separates a QSAN from the LLMs running on the very B100 chips we are talking about collateralizing?
The architecture of a QSAN is engineered for the anticipation of surprise. Rather than relying on data-driven prediction extrapolated from historical correlations, they execute outcomes-driven AIOps based on causal mapping.
Causal mapping, okay.
Dr. Malhotra describes them as quantum mines. They do not merely search for historical patterns, they dynamically model the complex, nonlinear interactions of the system in real time.
So they adapt on the fly.
They are completely self-adaptive, meaning their internal algorithms evolve instantly in response to discontinuous change.
This sounds amazing, but also, incredibly abstract. Let's pull this framework directly onto the trading floor.
Okay, let's do it.
If I'm an institutional risk manager staring at $10 billion of CCO exposure, we know the standard VAR model is giving me a false sense of security based on the last 36 months of exponential AI growth. How exactly does deploying a forward AI system at QSAN tangibly alter my risk management protocol? Or, save me from a market crash?
Let's go back to the debt service capacity equation. DSC is a function of utilization, price, cost, residual value, the risk-free interest rate, and the tenor of the debt.
Okay, DSC equals F of U, P, C, R, V, R, T. Got it.
Debt service capacity is the lifeblood of the SPV. A backward AI model will analyze this equation by looking at the recent past. Utilization has been 95%, compute pricing has been sky high, and residual values are holding because demand outstrips supply.
So it calculates the DSC as robust and just clears the portfolio for further leverage.
Right. It assumes the straight line continues forever.
But a forward AI system wouldn't just assume continuous 80% AI growth.
No, a forward AI system operates similarly to the ABMS JADC2, the Advanced Battle Management System, and Joint All-Domain Command and Control frameworks utilized by the Pentagon.
Wait, how does a military command and control framework translate into evaluating a corporate debt covenant?
By treating the macroeconomic environment as an adversarial battle space. A battle management AI does not assume the enemy will repeat yesterday's tactics. It continuously generates real-time adversarial counter-command models.
Oh, I see. It doesn't project a trend line.
Exactly. It actively maps the causal relationships between variables and stress tests the system for catastrophic confluence. It asks, what is the exact breaking point of the DSC if utilization drops by 15% due to a new model architecture requiring less compute, while baseload electricity costs rise by 12%, and the secondary market price for H100s drops by 30% because a hyperscaler just dumped their inventory all within the same fiscal quarter?
It hunts for the nonlinear cascades.
Yes. A slight dip in utilization alone might be survivable. A slight spike in power costs alone might be survivable.
But the forward AI is looking for the specific combination of shifting variables that creates a quantum collapse in the debt service capacity. It anticipates the nonlinear interactions that cause systemic crises.
Precisely. It moves risk management from attempting to predict predictable failures to engineering assured outcomes through the continuous anticipation of multivariable shocks.
Understanding this difference between backward and forward AI shows us exactly why the current AI credit transmission mechanism is a ticking time bomb.
It absolutely exposes the most critical vulnerability in the current market, which is heavily emphasized in our research, the second derivative threat to the AI credit transmission mechanism.
Let's talk about that. In calculus, the first derivative is velocity. The second derivative is acceleration. Are you speeding up or are you slowing down? Applying that to CCOs implies that the entire financial structure doesn't actually require the AI industry to contract in order to blow up.
That is the terrifying reality of immense structural leverage. An SPV loaded with senior and mezzanine debt does not need AI growth to turn negative to trigger a default cascade.
It merely requires the velocity of growth to decelerate.
Yes. If the underlying financing the covenants dictating the yields to the fixed income investors was modeled on the assumption of 100% year-over-year revenue growth to absorb massive influxes of new server capacity.
What happens when the market matures and growth slows to a perfectly respectable but much lower 25%?
A 25% growth rate is an economic triumph in almost any traditional sector. But for a hyper-leveraged CCO modeled on hypergrowth, it is a death sentence. The debt service coverage ratios instantly deteriorate.
because the operational cash flows generated by the 25% growth are mathematically insufficient to satisfy the interest obligations that were underwritten at 100% assumptions.
Exactly. The equity cushions are immolated before the underlying tech tenant even registers a formal corporate default.
We are looking at a tightly coupled circular credit transmission loop that acts as a financial accelerant. Let's map the capital flow for you listening, because it's wild. A major silicon manufacturer, let's use NVIDIA, as the proxy, takes its immense cash reserves and invests heavily in a promising foundational AI startup.
The startup, suddenly flush with capital, utilizes those funds to execute a multi-year, billion-dollar compute lease with a specialized cloud provider.
The cloud provider then uses that guaranteed lease as the underlying collateral to establish an SPV. They issue CCO debt to pension funds and insurance companies.
And then the SPV takes the institutional cash and immediately buys thousands of brand new GPUs.
And where do they buy them? Directly back from NVIDIA. The cash completes the circle, inflating NVIDIA's market capitalization, which broadens the perceived stability of the entire ecosystem.
Which in turn justifies Wall Street issuing even more CCO debt to fund the next hyperscale data center.
It's a perpetual motion machine fueled by leverage.
And the Bank for International Settlements is already flagging this architecture as a sophisticated evolution of shadow borrowing. Major tech entities are utilizing these dedicated external vehicles to substitute long-term operating commitments for upfront capital expenditure.
It allows them to keep billions in structural obligations completely off their conventional balance sheets.
Yes, it is an incredibly fragile, tightly coupled loop vulnerable to the slightest deceleration.
Well, if this loop is as inherently unstable as Dr. Malhotra's forward AI models suggest, the immediate variable introduced into this equation is the state. How is the regulatory apparatus viewing this? Because government intervention, or the lack thereof, is the ultimate nation uncertainty.
It really is. The regulatory landscape is currently fractured into deeply opposing paradigms. Advocates for stringent intervention, often on the left, are pushing for frameworks modeled heavily on Dodd-Frank.
So heavy oversight.
Right. They demand mandatory central clearing for all CCO-related CDS to illuminate the counterparty web. Furthermore, they are advocating for punitive capital surcharges on any systemically important financial institution holding CCO equity or mezzanine tranches, effectively treating them as highly toxic illiquid assets.
Which would instantly freeze the credit markets fueling the infrastructure build-out. And the counter-argument on the right.
The counter-argument champions market-led efficiency and views heavy intervention as a threat to national technological supremacy. From this perspective, CCOs are highly efficient capital allocators.
Because they democratize access to compute, allowing smaller AI innovators to access hyperscale infrastructure without requiring massive upfront venture capital.
Exactly. They argue that attempting to heavily regulate this emergent market will simply drive the innovation offshore, and that institutional investors possess the sophistication to price the structural risk appropriately.
Now, to be clear, our goal here isn't to validate one regulatory ideology over the other.
No, absolutely not.
The critical takeaway for our analysis is that the sheer unpredictability of the regulatory response, whether the SEC suddenly bans naked CDS on compute assets, or whether the Fed steps in to backstop a failing SPV, that is a massive, unmodeled variable.
It is the definition of nation uncertainty.
A backward AI VAR model cannot calculate the probability of a sudden congressional subpoena freezing asset transfers. It requires the causal mapping of forward AI to even begin to understand the systemic shock wave of that kind of regulatory whiplash.
Which brings us right back to the foundational premise. We have constructed a breathtakingly complex financial architecture on top of the most volatile technological asset in human history.
So what does this all mean for you? Let's distill the sheer magnitude of what we have covered today. Wall Street has engineered the Collateralized Compute Obligation. It is a highly effective vehicle for shifting CapEx risk off corporate balance sheets, but it harbors explosive terminal risks due to the accelerating obsolescence of silicon and the severe oligopoly concentration of the underlying tenants.
We have observed the layering of credit default swaps onto this market, a derivative architecture that introduces severe basis risk and raises the specter of AIG-style counterparty contagion.
Most importantly, we have applied Dr. Yogesh Malhotra's critical lens to reveal that the financial system is attempting to manage this dynamic quantum-level uncertainty utilizing backward AI models. They're applying the static mathematics of a roulette wheel to a multidimensional adversarial battle space.
And transitioning to QSAN's forward AI, built for the anticipation of surprise, is not just an upgrade to a risk dashboard. It is a fundamental paradigm shift required to prevent the mispricing of AI from crashing the global credit markets.
It is the necessary evolution from managing predictable catastrophic failures to engineering assured outcomes.
Well said.
I want to leave you with a final thought to analyze as you watch these markets evolve. We are currently building an immensely complex financial system that relied heavily on algorithmic modeling to price the risk of the very hardware that makes those algorithms possible.
Yeah.
What happens when a sufficiently advanced self-adaptive model analyzes the CCO market, maps the Nician uncertainty, and mathematically determines that its own underlying silicon is vastly overvalued by human institutions?
Oh, wow.
Will the algorithm quietly begin shorting its own infrastructure? Are we inadvertently engineering a self-aware financial bubble?
That scenario represents the absolute frontier of dynamic adversarial uncertainty.
It certainly does. Thank you for taking the time to explore this deep dive with us. As you look at the risk models governing your own industry, ask yourself the hard questions. Are your systems merely driving forward while staring fixedly into the rearview mirror? Or are you genuinely built for the anticipation of surprise? Until next time.